Welcome back to Corporate Radar on Bazaar. Well, the market has given up a bit of its gains, but still about 85 points higher on the Nifty. We're above the 17,700 mark, but for now, we hit a high of 17,783, and we'll come off just about, a few points here and there. For the market. But the CEO of Tata Steel, TV Narendran, says that time is running out for the company's UK business. Speaking exclusively to CNBC-TV18, he said the breathing space is vanishing and he hopes that the UK government will take a decision on funding very soon. Listen in.
I think there's a new government, so we'll wait for the new government to be in place, and we will continue the conversations that we've had with the previous governments, and I think we will look forward to an early resolution, because obviously with high energy costs and the economic situation in Europe, the business, which is inherently fragile, will struggle going forward unless we take some calls very quickly.
Mm-hmm. And I would imagine that these are difficult calls that will have to be taken. But given the precarious position that the UK government finds itself at this point in time, and the economy finds itself, it is fiscally constrained. Is there hope or confidence that there could perhaps be a resolution by way of funding coming in from the UK government?
So, Shireen, there are two important things to keep in mind. Firstly, we are a very important part of the value chain in the UK. Right? So it's not just about Tata Steel. We supply more than 50% of the steel used by the auto industry in UK. We supply more than 50% of the steel used by many construction companies in the UK. We supply a lot of the steel used by the packaging companies in UK. So we are a very important part of the value chain in UK, and hence there should be an interest in beyond Tata Steel's interests, right? So that is one part. The second part is, if you look at governments across Europe, governments are supporting industry in this transition to a greener future, right? This transition cannot be done without government support. So there is policy support, which is coming in Europe, and hopefully UK will also have the same policy support. The second part is the government support for the expenditure that you need to incur to transition into a greener future. And our submission to the government has also been that what we have submitted is a business plan which can help Tata Steel transition into a greener future, but obviously it can't be done without support from the government. So I think that's where we are. I think so there is, from our point of view, there is enough logic, but obviously the government has to see the logic from their perspective as well. And of course, we are a very important part of the Welsh economy. We are one of the biggest employers in the UK. And it's not just the direct jobs that we create, it's the indirect jobs. And typically in the steel industry, for every steel industry job, there are 4 to 5 indirect jobs which are created.
Yes, you talked about the employment generated on account of the business that you run, and of course the value chain implications as well. But as part of this business plan that you have submitted, and given the current predicament that the business finds itself in, what is the kind of financial support that you expect from the UK government to be able to turn this around?
No, I don't want to get into specifics of that, but generally the ask from most steel companies to their governments across Europe is at least 50% of the capex that needs to be spent needs to be supported by the government. On top of that, there needs to be support on OPEX to the extent of the differential in energy costs when you move from the current energy sources to new energy sources. I think these are the fundamental principles, not just for Tata Steel, but pretty much all steel companies in Europe have been talking to their governments about, and so that's as much as I can say now without getting into the specifics.
I understand, but at this point in time, is there any possibility that the your India business, may also have to fund, the UK business in any form or fashion? Is that at all a possibility at this point in time?
I think the position we've taken, and which we've been saying for some time, is each of our businesses need to stand on its own. We have supported the business for a long time. We have invested a lot of money over the years in trying to keep the business going. But I think now it's time for other stakeholders also to chip in.
Mm-hmm. And I understand that you are still in the process of negotiations and conversations, and there is a new government. But is there any indication of when a decision is likely to be taken on this front? How much runway do you have at this point in time as far as the business is concerned? By when would you like the government to take a call on this? And if there isn't going to be the transition package that you seek, what then? Will it be easy to find a buyer in an environment like this?
So, Shireen, obviously the time available is depleting by the day, because we had a year when the steel prices were good, the spreads were good, the business could stand on its own. That gave us some breathing space, but that breathing space is rapidly vanishing because of the high energy costs in Europe and the macroeconomic conditions in Europe and UK. Right? So we don't have much time, so we need to get to this decision sooner than later, and I think that's been a submission to the earlier governments, and there'll be a submission to the new government. What are the options that we will pursue or discuss when we reach there?
All right, well, Mr. Narendran, then hoping that there is some resolution out there. Last couple of quarterly numbers as well, we've asked him this question. And let's see whether or not the UK government, since now we have a new government in place, they can come up with a resolution. The total cost to convert to green steel will be around 3 billion odd, and they want the UK government to fund half of that. So maybe next week when the management joins us yet again, post their results, we'll try to get an answer on that as well. Well, time to move on then. Real estate sales across the country have been booming in spite of rising interest rates. Anurag now says that housing sales in the top 7 cities will create a new peak in 2022 and will exceed the 3.6 lakh units. Data from Knight Frank shows that Mumbai has seen a 35% year-on-year growth. NCR is up 21%. Bengaluru is up close to around 15%. That's the rise in Q3 of 2022. We have with us Mr. Anuj Puri, Chairman of ANROC, as well as Ghulam Zia, the Senior Executive Director at Knight Frank, who joins in. Let's come across to you first, Mr. Puri. Now we have interest rates hikes that are taking shape, and the real estate sales have been great. Do you think that we are, we are likely to see some impact on demand from here on because of these higher interest rates?
It is interesting the way that the residential sales has continued. Certainly we thought that during the COVID times that this was largely a COVID phenomena, or there was a pent-up demand, or people were working from home, and that's why the residential sales had spiked. But, it appears that this seems to be a long-term cycle. The urge to buy residential, the social security, somewhere that roti, kapda or makan, that makan had got lost, has come back into the priority for the guys. And clearly the numbers are reflective of what has happened. Even in the Shraddh period, which is the Pitru Paksh, the inauspicious period, we saw the highest number of registrations in a decade. That has happened is. So, clearly the numbers, as you rightly said at the start, the 9 months of 2022 calendar year has already surpassed the sales of 2019. And we think by the end of 2022, it will surpass the sale of 2014, which was the previous peak that we had seen on the sales. Now, is the high interest rates going to impact the demand? Certainly. I mean, I think there will be 3 things that can impact this party which is going on. Clearly, if the home loan rates continue to go up and, start to touch 10%, clearly that will have both sentimentally and financially an impact on the buyers' thought of buying resi. Second, I feel is that the inflation, which will continue to eat into the savings of the people. And third is that, if there is going to be a global recession and India does get caught out, then clearly, as an economy, if we do slow down, then it will have an impact on the real estate overall and including the residential. But at this moment in time, I can tell you is that the residential demand continues to remain very strong and very stable.
Ghulam, similar question to you actually. Do you endorse this kind of optimism which ANROC's numbers are showing? Any red flags at all in terms of interest rates or inflation or global, IT jobs not being as good as one thought 1 year ago? Anything like that? Any red flags?
To start with, I would wholeheartedly support the analysis that Anuj put across. In fact, our own calculations that we're trying to, what Anuj spoke about, the pent-up demand, we tried to quantify that. And this was pre-pandemic when the economy was doing well, shares, stock markets were doing fabulous, real estate, housing markets were dipping year after year. So we tried to do some calculations, and it clearly shows that there is almost about 500,000 units that could have been sold those days if real estate was to do its regular sales per year. And that pent-up demand is lying somewhere, and that's one thing which we are looking at coming in these days. And second thing that we are all talking about is the interest rate. As we spoke about 2012-13, interest rates were closer to 10%. Home loan rates are about 10% odd. We are still at 8.5%. So there is still quite a runway available for us to continue to enjoy this this euphoria. So the transaction numbers shall continue to me over and above what Anuj spoke about. One thing which I am worried about is whenever the markets are good, the developer tend to increase the prices relentlessly. And that's my biggest worry. And that's perhaps what he spoke about inflation. And developers play a big role in taking the prices up towards the inflationary curve and beyond the affordability. So me, the biggest concern is breaching that affordability mark. As long as we are not doing that, I believe next year, year and a half at least, we have nothing to worry about.
So when you talk about a price increase, right, Ghulam, so far in Q3, if I'm not wrong, there's been a 6% price hike across the board on an average, which is, I think, the highest we've seen in many years. Can you just break it up for us? How have the key markets done in terms of prices going up, whether it's Mumbai, Ahmedabad, Hyderabad? And do you see more price increases now over the next 6 to 12 months?
Yes, actually 6% that you're talking about, Mumbai has seen the maximum of that. And Mumbai also, let's not forget that during the days when the markets were falling, Mumbai was bearing the brunt the most across the markets, because it is very high price market, and due to increase in cost of construction and of course the land values shooting up had an overall impact on the margins of the developers. And most of the developers, without an exception, were worried about these costs going up. And that was reflecting in the price rise. But then, about 5-6%, which is pretty much closer to the inflationary trend that we have, that kind of a rise is possible. It's actually something which the buyers will be fine to tag along with. The problem is when we have seen it earlier, more than 10% per annum kind of a price rise continuously for years together, at least about 3 to 4 years, had taken the affordabilities completely, thrown them out of the window. And that's the concern. So about 5-6% here and there kind of a rise. And mind you, when you're talking about 6%, a few markets didn't see that kind of a rise either. Say about a Bengaluru, it was not that high. Neither was Pune. In fact, Pune was one market, and of course Kolkata, where the prices were flat, if not reducing. So overall, of the top 7-8 markets, the price rise is yet not that worrisome. I would be worried if it's a more than 6-7% kind of an increase per annum, then that worry would begin.
Okay, all right. Anuj, coming back to you then, is that shift from unorganized to organized still happening? Because some of those unorganized players, they are coming up with these bigger, projects as well and new launches. Your sense?
So 100% it is happening. I'm surprised that the unorganized are starting to come back, because clearly the demand from the home buyer is only towards the organized. I mean, look at the sales for Lodha, DLF, Brigade, Shobha, Purvankara, Oberoi Realty, any of these listed guys, they have done exceptionally well. The reason for that is that the home buyer is saying is to the unorganized developer that either you complete the project. If you have completed the project, I have no problem buying your inventory. But if it is under construction, then I don't want to buy it, even if you are giving to me at a discount of 10 to 15%, because the surety that you're going to be able to deliver in these uncertain times is just not there. And hence, I'm going to gravitate towards a grade A developer. And that's where you're seeing most of the listed guys really benefiting in this market, whilst the sales are going up. But equally, through the consolidation, they are having a double benefit, because many players are also exiting this market who are not going to be able to sustain from their own funds to complete the project without the pre-sales happening.
Okay, gentlemen, we will leave it at that. Thanks a lot for joining in and talking about the sector, which is on a tear right now. Both experts saying that despite interest rates rising, demand will not get hit. And it's only price hikes which are a bit of a concern, but that as well, only in key metro areas. Otherwise, things are looking pretty good. Let's take a quick break on that note. On the other side of the break, Mitesh Thakkar will be joining in to give us some technical trades at 10 a.m. We'll also get the focus on the commodity space. Stay tuned.
Welcome back. Well, just focus on one stock, NMDC. We had told you, on Tuesday itself, if you wanted to be part of both the entities, that's the core business, iron ore, as well as the steel business, then Tuesday was the last day to purchase. So today the stock has gone X, and that's why it's just the core business that's trading. It's adjusted by close to around 30 rupees or thereabouts. So the street is building in a valuation of around 30 to around 40 rupees for the steel business, which in all probability will list a couple of months from now. So it's gone X the steel business. Just want to point that to our viewers. It listed at around 10 a.m. today. Well, let's get Mitesh Thakkar in. Mitesh, well, we had that gap up, but that gap up has got sold into, and it seems the 17,800 mark has become a bit of a barrier. A quick word on the index first, and if you got a stock call as well.
Yeah. So Nigel, I in fact did highlight that, in case we open with a gap up, the first reaction would be to take profits, because 17,800, as you rightly said, is the technical pivot which the index needs to clear. And while the overall chart pattern is still positive, I think, there's always a chance that on the hourly charts, on the 2 hourly charts, we are very overbought. So there's always a chance when we hit an important pivot level on the upside, I think profit booking will happen. So we have exited our longs on the index and now are waiting for a dip to about 17,650, 670 zones to buy into it. But that apart, on stock side, still trading with long biases. I have a buy on M&M. After a few days of consolidation, is picking up again. So that's a buy with a stop below levels of 1272 for targets of 1350. And the other one which I like is JSW Steel. On day before yesterday, we had a buy on Jindal Steel and Power. I think JSW Steel is breaking out today. That's a buy with a stop below 664 for targets of 710.
Okay, by the way, just want to mention that Gland Pharma is a stock that's really getting hit hard now, almost 13% lower on that. Ekta was telling us about how the numbers are quite weak this time around. Remember, the stock is halved from its 52-week high. It's getting pummeled in trade at the moment. And Nykaa is the other one. Ahead of the lock-in expiring on the 10th of November, Nykaa is now down an additional 3% odd. So not looking good for some of these names. Mindtree as well is the other stock that's under pressure right now, down about 2%. But thanks for joining in, Mitesh, and giving us an update on the market. Let's shift focus to the commodity space now. Manisha Gupta is joining in. Manisha, what's the one commodity you're looking at?
I'm looking at commodity as a theme today, Sonia, because with the US dollar decline, we're looking at all commodities actually trading in the positive, especially the non-agro ones. The dollar index is trading at a one-month lows. We've seen 110 give way on the lower side there. And the dollar index now is nearly 5% off its 20-year highs that was hit in the month of September. And the fact that you could be looking at lower other currencies as well doing well. So the Chinese yuan has recovered. We've seen Canadian dollar recover, especially after that 50 basis points of an interest rate hike, even as markets were expecting 75 basis hike. So we have seen currencies also do quite better today. That has been supportive. Also, the fall in treasury yields is supporting the prices. You also are looking at the US Fed expectation that it may soften the hawkish stance by the end of this year. That is in December. There's now a 60% chance of a 50 basis point rate hike in the month of December. That clearly has been supportive as well. For today, markets will be watching out for the European Central Bank monetary policy as well. We also are awaiting the Japanese yen Fed policy, and you also have the US Fed on 2nd of November. So the next week, 10 days, also promise to be quite volatile there. Take a look at the commodities then, and the crude oil prices have continued to surge. We are looking at 4% of gains in this week itself. It has to also do with the record US crude exports at 5.1 million barrels per day is what has brought the prices to above $96 per barrel. Markets also will watch out for the OPEC and allies now effectively cutting 2 million barrels from the 1st of November. And there would be also on radar is the fact that the European Union may ban Russian oil imports from 5th of December. There also is conversation about banning or restricting Russian shippers from the global insurance industry there. Not just crude, gold is trading at a 2-week highs. We've seen $16.75 on that one. Silver has broken above $19.5 per ounce as well. You have copper prices trading at a 6-week highs right now. Metals for one seem to be really doing good as a sector right now. So you have copper trading at a 6-week highs, and the fundamentals really seem to have improved with the global inventories at just about less than 5 days of global consumption. Clearly continues to support copper. If you look at zinc inventories, you have 3 days of global consumption worth of global inventories. So the markets are wanting to take a look at the fundamentals right now. From the highs, we are still much on the lower side. But for the day, for the week, we are looking at some supports coming back into this space. For crude as well, while crude might be 4% up, but diesel or the gasoline prices, the petroleum product prices continue to be much higher. In the case of metal prices, while we are looking at 2 to 10% of a gain this week, the best of the gains clearly coming in for aluminum. That is outperforming. You are looking at lower supplies, lower inventories, demand picking up, and that clearly has been supportive for that too.
Okay, point taken, Manisha. It's a risk rally and it's helping commodities as well, both expectations of a lower rate hike from the Fed and therefore a lower dollar. The currencies, one would have expected that all currencies would be stronger, Asian currencies. That's not the case. The rupee is stronger because we missed trading yesterday, but the rupee went as strong as 82.14 when it opened, now more at 82.28. It even went to 82.35. So the strength was not retained. Looks like at lower levels, people are buying dollars. And just wanted to add to the 52-week highs you were pointing out, there's also Canara and South Indian Bank in the list of 52-week highs. A quick break, and on the other side, we are back to our festive analysis. We're going to check out whether the festive season has seen an increase in demand and in which pockets. We'll be joined by Manish Rajsinghania of the FADA, the Federation of Automobile Dealers Association, and Teresa John, the economist from Nirmal Bang Institutional Equity.